Welcome to 507 Week 3, Module 1. This week we're going to cover the estate tax, which is a very difficult sessions. We've got 7 of them, and I might also note that between estate tax this week and gift tax next week, it is the same thing that would be offered in the law school course, and that law school course would run 15 weeks at 3 hours each. Or it would be in a master's in taxation for CPAs, again 15 weeks for 3 hours each. So obviously what we're going to cover is very complicated, and it's also should be obvious that we're not going to be able to get into the depth that is required to actually do estate taxes. Our goal is to be able to have you be able to communicate some of the concepts with your clients, and also be able to communicate with the tax preparers, the tax accountants, and the lawyers who are involved with state tax. Under today's law, and it's been true since 1976, estate and gift taxes are really one tax. Up until that time, they were two completely separate taxes. However, since 1976, they have been unified. The way I put is that in 1976, the Congress gave themselves a present. For the 200th years since the Declaration of Independence, they increased the taxes. And in some ways it's made it simpler because it's one unified tax. In other ways it's made it more complicated. I think one of the biggest difficulties that people in general have, especially clients who are not familiar with the rules of estate, and I think most people are not familiar, is that the total gift taxes are not known until the year of death. Now, we fill out a gift tax return every year that there's a gift being made, but we don't know what the true tax is until the year of death, and therefore we may have a way understatement or a way overstatement of the taxes as we're going through the years. What makes it even more difficult is Congress tends to change the rules a lot as to tax rates, thresholds of taxes, etc., in the area of estate and gift taxes. And I would also noted here as a separate point that the thresholds also are only in effect at the date of death. Therefore, tell me the year of death and I will tell you the impact. Many times these rules are retroactive from the end of the year back to the beginning of the year. It's not uncommon when it's December 27th or 28th that Congress retroactively does a state and gift tax rule that goes back to the beginning of the year. I think the one that many of you will be familiar with is the one that's associated with 2010, because in 2010 we had a rule that went from no taxes that year to the best decision was to pay a tax for the year, retroactively, of course. It's a number of ways to eliminate and defer these taxes, as well as decrease it. That is not found in other tax systems. In fact, a good way of putting it is many times people do not have to really pay any gift or estate tax if they do good planning and they happen to die in the right year, which requires a little bit of luck. And I might know many times you're required to fill out an estate tax return even though no taxes due. Now that is not true in a lot of tax situations, but it is true in estate. If you meet the threshold for the tax, which is based on $5 million with a inflation factor added per year, then we would have to fill out the tax, even though nothing's due. No, there's a number of reasons why nothing would be due, but you'd have to fill out the tax, and that's what we're covering this week. The gross estate is the starting point. The gross estate is not what you expect it to be. It's a lot more, and I think that this is probably the thing that people probably do the worst on the CFP exam of anything in the estate tax area, because it is very complicated of the assets that make up the gross estate. The way I put it is figuring out the gross estate is one of the hardest things to do in taxation, but doing the actual estate tax form itself is one of the easiest things in taxation. So that might sound a little strange, but I think you'll agree with me when we're done. The gross estate consists of all assets in which the decedent had an ownership interest in. That could be a joint interest, it could be interest that's solely yours, it could be anything that basically has value as an asset, could be included in the gross estate, and it's shown at the gross value, not the net. So if you have a client who has a house with a fair market value of $500,000, but the debt on it is $700,000 for gross estate, the $500,000 is used, we ignore the debts. There are also 9 categories of additional items that are not part of the assets that are covered in Module 2, and that's where the surprises are, and that's where the complexity is, and we'll wait till Module 2 to go over those. And finally, the last thing on this particular chart, we talk about estate taxes based on the accrual basis, not the cash basis, and that makes it difficult. Your income tax for individuals is done on a cash basis. At death, it transfers over to an accrual basis. And as a result, we have to have some vehicle to handle it, and that is called the income in respect of the decedent, and IRD. And I think you're going to find that that is also a difficult concept, and many times it's difficult to figure out who has to pay it and what form they paid on. Estate tax is due 9 months after death, and that's easy to remember. It takes 9 months from conception to birth, 9 months from death to when the estate tax is due. And like income tax, we can get an extension very easily for the filling out the tax return. However, the actual tax itself is due 9 months after death, and the extension on the tax return sometimes is needed for 4 or 5 years because you have to wait till probate is done, or if you have outstanding lawsuits, if you have outstanding loans that you're looking for, or debts that are being looked for. Until all of that's resolved, you have to keep the estate tax open. Reasonable justification will allow for extensions of payment, subject to payment of interest and penalty for payments made after the 9 months after death. And I have a philosophy. I always have the clients pay more than we expect to see at the 9th month. And the reason I do that is if they later wind up getting money back, they're really happy. Where if they later have to pay more money, then they're very mad. And I'd rather have a happy client than a mad client. So I think it's always a good idea to avoid those penalties and interest, plus the payment of additional costs by overstating the amount that you expect to have to pay when you make the payment in the 9th month. You know, same thing I do on income tax. Substantial documentation is required to submit it with the tax return. With your income tax return today, you do electronically. There's nothing other than the forms, and it's very easy from what's submitted to the government. That is not true, and I want to put not true for estate tax. Estate tax, you have substantial documentation. Any trust, any power of appointment, any power of attorney, any deed. You may even have to provide your passport or your authorization to live in the United States with it. Any insurance policies, any debts, any asset, all have to be included, because not only do they want the form, but they want an appraisal for all of it. So the expenses to put this together can be very high. For example, a lot of appraisers dealing with furniture or artwork charge by the piece, and if you got a client who has 50 or 75 pieces of artwork, they may have a very substantial amount of work just coming up together, coming up with all the appraisals, and each one of them is usually charged separately. So if you have 45 or 75 items, you're going to be paying for 45 or 75 appraisals. The estate tax return itself is Form 706, which you can look up by going to the IRS table on the internet, or if you prefer, you can go to week 3 information, and we have a copy of it there. It's changed a lot in the last couple of years. It's always been a long form. Longest I can remember is probably 49 pages long. It's shorter right now, but who knows what will happen next year. And it covers the following types of items. First of all, the taxable estate, which we'll be getting into this week. The cumulative taxable gifts, which we cover next week in week 4. The estate tax credits, which we'll cover next week. And the generation skipping tax, if applicable, which we will cover in the 8th week. That is the end of our sessions for the first module, and we will be going into the second module information as soon as you want to. I advise you to have a pencil and pen before going into that module, because quite honestly, you're going to find that it is going to require you to memorize a lot of things that you're not going to be able to memorize, and therefore the pencil and the paper will work very well to be able to gather the data from that week's